Hey YouTube, this is Zach with Achilles Financial. Today I'm going to be talking about DraftKings Inc. And the reason why I want to highlight this one is this is a stock that has been absolutely mutilated over the course of the past 2 months. And it's a company that I like, but they do have quite a number of concerns. And we're going to talk through that today. One of the overall things that I will highlight is we are in a market right now where a rising tide carries all ships. And as we see a lot of the ships go up due to the number of ETFs that have really purchased into the entire market and into entire sectors, we are seeing a lot of companies that have just been absolutely floored and have done really, really well over the course of the past few months. And then we've seen double-digit drops in single days and single weeks to a lot of high-flying companies. And DraftKings is definitely in the boat where they're actually returning negative on the year at this point in time. One of the things I would highlight is what we need to do when we're looking at stocks and evaluating stocks is I like to use the term buy and do homework. That's one of Jim Cramer's favorites from his book Sane Investing in an Insane World. And I really like it because we can look at some of these companies and say, yes, they're beaten down, but there is still potential going forward. And there is a lot of companies out there that I look at and I say there is not potential going forward. But one of the key things that I really like about DraftKings that you can see here is that they do have a held by institutions percentage, and this is calculated as of this past quarterly filing, which came out about 4 weeks ago now, is 60% of their outstanding shares are owned by institutional investors, which already points to me that there is strength in the investor base. There is a lot to like, as well as we also see, and I don't know if they'll have this on here, but we actually saw it just came out. It doesn't look like it just came. So 11/18, we actually saw some of the internal management just came out and actually purchased or executed stock options to raise the value of their shares. So we're seeing that occur. There is a lot of belief in the company, but we really need management to execute. And they've been growing at the same rate that they expected, but some of the concerns have come with the fact that they have done a series of debt offerings already. This is a company that came public via SPAC. They were a very high-profile company with very lofty profitability expectations, and they are not even close to those profitability expectations at this point in time. As well as we've got a company that there's just a lot to like, a lot of growth in the industry, but they're losing a ton of money the more that they bring in. And so the reason why I highlight this and why I want to talk about DraftKings is I think that we're getting to a price that it's worth starting to nibble at. What I want to highlight here whenever we talk about these companies, whenever we have these conversations, is that when we're talking about companies that have gone public, you have to look at the point in time when they went public, which I believe was actually, I think this may have been January of last year, but I want to say it was February of 2020. You can see some of the volatility during that point in time, and we're rapidly approaching some of those key levels back in May through September of last year. So this is a stock that's been in the 70s, been in the 60s, and we haven't seen it in the 30s for quite some time, at least not in 2021. And it is a company with a lot to like. So what I'm looking to do here, I am a shareholder, albeit a small one. I believe I have 15, maybe 17 shares of DraftKings. And this is a point where I think I'm going to start adding to that position. I would like to get up to 100 shares so that I can sell covered calls on the position. But this is a company where there's a lot to like, and I'm going to start nibbling at these levels. What I'm looking to do is dollar cost average into a position here. As I previously mentioned, I'd like to get 100 shares. So every 2 weeks between now and the end of the year, I may look at putting $200 to this position till I get up to that 200 shares. But I don't think that we've hit a bottom. I think the market overall has been getting pummeled today, and earlier this week we saw everything kind of going up. But in some of these names, they're just getting pummeled, and the overall market has gone up because of primarily QQQ stocks and even bank stocks today, but there was a lot of non-high performers that did very, very poorly over the course of this week. DraftKings was one of them. So what I'm going to look at doing here is scale in. I'm not going to try and time the bottom, but I think that this is a company that has a lot to like, and as such, I want to begin building out that position. Some of the things that concern me when I look at DraftKings is their financials, and that is a big deal, and one of the reasons why I'm not saying, hey, throw all of the money I have allocated that I'd want to put into DraftKings in right now. Just to showcase what that position looks like, let me bring over their presentation. So what I've pulled up is their adjusted EBITDA and their profit and loss. And the key things I want to highlight is they've actually broken out the expenses of sales and marketing to cost of revenue. I don't necessarily agree with doing that, but this calendar year, their sales and marketing expense alone was $703 million, and their total revenue was $822 million. You can see for the first 3 months of the year in both 2020 and 2021, we saw the sales and marketing expense were nearly double, at least 1.5 times in 2021, what we saw in terms of overall expense ratio. So the sales and marketing expense is absolutely destroying them, because as they bring people on, they're saying that, yes, we're paying a lot, but they're going to pay that back over time. And we're not seeing that clearly at this point in time. So what I am seeing a huge expense for on the calendar year especially is I have nearly $500 million in stock-based compensation, when the overall losses that I'm seeing down below, which again, I don't believe in adjusted EBITDA. I think that this is a made-up number. What I'm looking at is negative $550 million. But a net loss overall for the year after 3 quarters is $1.2 billion, with a lot of that coming from, you can see stock-based compensation, you can see a $703 million sales and marketing expense, and we really have to see some company leadership where they come out and say that just because we have cash doesn't mean that we're going to burn it. They do have quite a bit of cash still on their books. They've got more than $2.5 billion, or at least they did as of the date of this particular pricing, and they do have a lot of revenue. You can see that growth in terms of year over year. It's nearly 4x in terms of 2020 to 2021. I expect Q4 to be another big one. Sports betting is something that the states will continue to grow, so I'm not necessarily worried about revenue growth. I'm worried about what they're paying to drive that. I mean, if I go out and try and grow revenue by giving away free money, it's pretty easy to do. To keep that money seems to be what they're struggling with. So as such, I have a lot of concerns with the management approach right now, but in terms of the product, in terms of the actual capability of this company to produce, the company is currently valued at a total market capitalization of about $15 billion at this point in time. They've got cash equivalents here of, at least at the end of the quarter, of $2.647 billion. And if we assume that this is still going to be over $2 billion, then they're trading right now at a $15 billion market cap. They have cash and short-term investments of, we'll call it probably $2.6 billion as of today's numbers. But they've got a lot to like out there right now in terms of their balance sheet capabilities. They need to figure out what's going on the income statement and need people to stop bleeding stock in terms of some of those stock options. If they can turn a lot of that around, they have a very attractive business model, and the growth is there. The market is there in terms of the total US betting market. And I really want them to focus on that instead of overpaying for stupid investments like we saw earlier this quarter with the Entain or Entain. It was the MGM partially owned betting agency in the UK that they were rumored to potentially be paying a deal for. I want them to focus on the domestic market and growing that and building a profitable business here before they continue to try and expand out there. So these are just some of the things that I am going to be watching for. All in all, this is a stock that has so much incredible value in my opinion. It's just not showcasing that because management is executing poorly. And as such, I'm going to be scaling in because at this point, I don't think that they're done executing the way that they are. And so as such, I'm going to continue to watch them, but I will start building a position. when I get that 100 shares, I'll be selling covered calls because the premium on their positions tend to look pretty nice. So I'm going to start doing all of that. If you want to see any of that, I post all of my trades in the Discord, which is linked in the description. That's free to join, and it's something that we have a lot of fun with talking there. So if you find this type of content helpful, let me know in the comment section down below, and by hitting the thumbs up button, it really helps the channel to grow. Thanks for watching if you made it this far, and I'll talk to you later.